Good afternoon. My name is Andrew Barden, the CEO of the Kenyan Wall Street. I have a very special guest here today. This is only Tuesday when we're recording this, and markets are already super chaotic this week. So we brought a special guest to help us understand what's going on. So Ronny, thank you for joining us.
Thank you so much, Andrew.
So please, for our viewers who don't know who you are, could you introduce yourself briefly?
All right.
What you do?
My name is Ronny Chokaa. I'm a senior research analyst at AIB-AXYS Africa. My scope of coverage ranges from macroeconomics, equities, and fixed income analysis across the East African financial services industry.
Perfect. Well, thank you so much again, Ronny, for joining us.
Thank you.
Man, what is going on in global markets? It's chaotic. Everything from Japan to New York to Germany, everywhere is in the red this week. So I guess my first question is from a macroeconomic global perspective, what is going on right now in global markets?
Great. Where do we start? I think the global markets have been volatile over the past 2 weeks, counting. Starting over the US, the latest Fed meeting, opting to retain the benchmark rate, defying expectations of the first rate cut coming in August. So markets have opted to defer the expectations, and what that has meant is that we've seen bond yields, especially on long-term 10-year and even 2-year US Treasuries, the yields have started coming down.
Yeah.
The latest key Fed decision was by the Bank of England, where they opted to lower their benchmark rate by 25 basis points, following in the footsteps of the European Central Bank just a month earlier. And I think that enshrines the direction that yields are generally expected to take on, especially by key markets.
Yeah.
But that has also come at a time when, if you look over in Asia, the Bank of Japan elected to raise interest rates in a bid, of course, to stem the inflationary pressures that are rising in that market, and also to exert some yield curve control.
Okay.
They also elected to halve their bond purchases. So that has meant, in a global markets context, just to put it into context, we know that in Japan, they've kept their benchmark rates at near zero levels over the past 17 years. And that allowed global fund managers to exercise what we call carry trades, which is essentially borrowing in yen to go and invest in other non-yen assets, US Treasuries, US equities, European equities as well, and even Japanese equities. So that has been going on over the past 17 years. So the move by Bank of Japan to raise interest rates was almost unprecedented.
Historically,
it was momentous for markets, and it almost threw markets in a frantic. We started to see risk of sell-offs in U.S. markets. It did not help either that the U.S. jobs report came in adversely or lower than expected.
Significantly lower. And with jobs reports, especially in the U.S., they almost always are revised down a week later. But they do that quietly. They don't tell the world they were revising down.
Yeah.
But
so
it's worse than probably what they're saying right now.
Exactly, because over the past more than 24 months and running, benchmark rates in the US have been at very elevated levels, and that has brought a lot of pressure for businesses, consumers. Already the fiscal buffers that the government extended to US citizens are almost dissipating from the economy. And now the material effects you're starting to witness is that unemployment numbers are starting to tick up, signaling that perhaps the US economy is entering the much feared recession. So the narrative of the soft landing appears almost elusive. If at all the Fed does not convene soon enough
Okay.
to make the appropriate decision, which is to lower rates at this point.
Yeah, and Jerome Powell missed the opportunity to lower rates last week.
Yeah.
But, when you see, like in the US, there's always emergency rate cuts that they can do.
Mm-hmm.
Do you think they may, if this continues, if we continue in the red for 2 weeks, that they may consider an emergency rate cut?
Yes, markets are pricing in a 60% probability that the Fed may meet intra-period to lower rates. And this is occasioned by, of course, the red data we are getting, especially in the pointing out to the recession that they've been feeling all along,
Yeah.
And, since monetary policy tends to have their lags, so meaning that even if the Fed were to lower rates abruptly, even by 1 percentage point, it wouldn't necessarily translate or trickle down to a downtrend in unemployment.
Yeah.
It will take a while. So we're almost now in the muddy zone.
Yeah, it's in a weird spot because central banks often deal with, correct me if I'm wrong, 2 issues primarily.
Yes.
Inflation and unemployment.
Precisely.
The US Fed is in a weird position where now it has high inflation and high unemployment.
Yes.
So, and the economic war chest that they have doesn't exactly align. They can't just print money.
Yeah.
I mean, well, the U.S. can just print money, but, there's the inflation cost to that and such. So, I guess my next question, though, is we're talking about global markets, U.S. Fed, Japan, Germany, UK. Why does this matter for Kenya? How does it impact Kenya?
It's a great question, because given the interconnectedness of the global economy at this point, and the free mobility of capital across jurisdictions, key decisions by central banks have material and traceable effects to emerging and frontier markets such as Kenya, such as where we sit. Even if you look at some of the trading action on our blue chips, we've witnessed accelerated sell-offs over the past 2 days.
Yeah, what do we see? Total yesterday was a good loser.
Yeah, Total. I mean, even the trading board right here, you can see
What do we got?
a lot of blue chips closing in the red.
I see a lot of red.
Yeah, that gives you the impression of the market. The blue chips are really under pressure. But at least we're starting to see some stability, but we don't know whether we're at the comfort zone yet.
Yeah.
Given even the yen has held up compared to yesterday. Yesterday the yen shed more than 3.5% in a day. We usually move in basis points, but 3 percentage points is a huge stretch.
Yeah.
Yeah. So we can trace that impact of course, the yen movements and the panic sell-offs that we saw on equities across developed and developing economies. And at the same time, we've also seen bond yields begin to decline, meaning bond prices are rising. So markets are warming up to the prospects of rate cuts in the coming. However, for equities, it's gloomy for now. Markets are interpreting bad news as bad news.
Yeah.
Yeah.
Okay, interesting. Now, what do we have? CBK tomorrow has its meeting, 9 a.m. What are your expectations for that?
In context of the recent developments, we know that inflation came in at 4.3%, which is significantly below the midpoint target of 5%. So that gives us the trend that inflation is heading in the right direction.
Yeah.
We're starting to see increasing prospects of key Fed rate cuts over the coming months. So that widens the wiggle room for the central bank to lower rates, to lower the benchmark rate, at least just one insurance cut.
Yeah.
Before the end of the year, as a signal or as a message to the markets that we want to help the economy take off from this slumpy zone we're in.
Yeah.
Because if you look at private sector credit growth numbers coming in at single digit, 6.3% as of April, which is very low. We should be playing in the double digit territory on the minimum. So I think at the present time, however, I think the central bank will tend to nudge towards a wait-and-see approach.
Okay.
Given the uncertainty looming in the markets, I don't think they would want to act too soon. Probably wait for the market angst to settle a little bit before making a sober decision, because price stability objective is dual-fold.
Yeah.
There is internal price stability and external price stability, which is the exchange rate. For one, we know that the central bank has been on a strategy of raising real yields to sort of anchor the shilling.
Yeah.
And we've seen the shilling has now taken on a stable footing.
Yeah, but it's done quite well this year. What, the world's best performing currency?
Yeah, one of the best so far.
Because we came from close to 165 around January 25th.
Precisely.
To, I think I transferred my rent money today, and it came out to like 129.5, 129.8.
Yes, exactly.
So, but I know last week we had a blip. We had a blip toward, I think, Wednesday or Thursday where we got up to almost 133. And in these numbers, I guess it's important for viewers to know that we're talking about USD shilling rates. That's typically the one people use anyways. But, okay, now I think it's important to understand why, I mean, how if CBK were to cut, what does that mean, for the common man? How does that change their life?
All right. If at all the Central Bank of Kenya were to cut interest rates tomorrow, that would mean it would open the room for banks to lower their lending rates to businesses, households. They'll be able to borrow more at a more affordable cost. It would certainly stimulate a sense of consumption and investment activity.
Yeah.
We would start to see even that reflect in the leading economic growth indicators. Further to that, we would also notice a downtrend in unemployment numbers. More businesses will be able to expand their activities, hire more staff, or even increase their wages to, expand their operations, as it were. So that decision definitely has significant implications for the common man.
Yeah.
It would also, now, because that's also pending the decisions by other central banks, it will also help give the shilling a more stable footing. If at all, even the US market, say they decide to lower their benchmark rates, it will drive further strength in the Kenya shilling.
Okay, and in turn, there's a lot of conversations going on now about government debt.
Exactly.
And such. So correct me if I'm wrong. I think I'm correct. But if we were to, hypothetically, if CBK were to drop rates, wouldn't that make it more affordable for the government to pay off debt?
I think you're very spot on, because yes, the weighted average cost of debt is a direct function of the benchmark rate. If at all the benchmark rate is so elevated, it reflects even in the yield curve. That means the cost at which the government is borrowing from the private sector is in the high teens, as it currently is. That in itself raises what we call the interest expense to tax revenue ratio.
Okay.
If at all tax revenues aren't rising as fast as interest rates are, then it presents a threat to debt sustainability.
Okay, and that's a big conversation going on right now because we're currently awaiting a high court decision on Finance Bill 23. Finance Bill 24 has been scrapped, so it seems many of the revenue generating models are disappearing, at least for the government side. So if you were, the president or sitting in that seat, that's not super encouraging because we all know the budgets have been increasing.
Yes.
And with the increase in debt, and I think currently the country spends over 70% of the money it collects just on debt. So that's a little worrying to me. What do you think in terms of, like, I guess, the medium to long term outlook of the overall Kenyan economy? You know,
Okay.
take for example, if I'm buying a 5-year bond, what should I understand about the economy right now?
All right. If we talk about the medium-term debt sustainability outlook for Kenya,
Yeah.
I think the government has really done a fairly good job over the past year to allay debt refinancing risks.
Okay.
That is to say, the ability of the government to manage its debt position has fairly improved over the past year.
Okay.
Case in point, we know this year we had a euro bond that was due to be paid in June 2024.
It's been paid, right?
It was paid 4 months in advance, partially, and then the remaining portion was cleared off in June. And the refinancing option came with an amortized plan. That is to say, we don't have significant bullet obligations due over the near-term horizon. So that presents a fairly stable outlook for even our balance of payments accounts, because we don't have large drawdowns at a single go. Domestically, what we've witnessed is that the weighted average cost of debt has been on the rise, undoubtedly. Yet at the same time, if we look at the net domestic borrowing targets, that has been declining over the past 2 fiscal years. However, for this fiscal year, following the shelving of the finance bill, the government had to raise its net domestic borrowing targets to compensate for the projected decline in revenues.
Yeah.
Yeah.
But you know what's worrying me about that now is, you know, the short-term T-bills.
Yes.
You know, so last week I actually got really worried, last week's auction. Because as we were discussing before the interview started, 91 day oversubscribed, 91 day looks good. The 182 and 364 not looking too hot. I know even that 1 year term was like just less than 11% subscribed. What does that tell? What should I understand about that?
Okay, I think activity in the T-bill market is reflective of the overall duration market, even the longer term 2-year and 20-year duration. That is to say, activity has been largely concentrated on the short-term papers, the 91-day T-bill, which is reflective of the market sentiment that, based on the perceived risk sentiment in the prevailing, we'd rather invest short term than long term. Okay. Or if at all you are to go long term, you have to make the interest attractive. The return needs to be as attractive for me to take up that risk. Right?
Yes.
So that's the sort of interpretation at play that's driving that demand to be skewed towards the short end rather than the long end. But never, 1 week in itself is a fairly small sample to compare conclusively that indeed demand is skewed on the short end. We also need to look at it in the context of activity in the bond market, the longer term duration bonds, where if you look at, as we speak, where the government floated an infrastructure bond, actually 2 infrastructure bonds, which are currently still on auction. And the returns being offered there are in the high teens, high 17s to, there's another one with 14.39 and another with 17.93.
It's not bad.
Coupon returns, yeah?
Okay.
So that in itself has driven activity, as funnel activity, away from the T-bill space
to the
bond market. Right?
Yeah. Okay.
Yeah. So we are waiting the results. I anticipate that it will be oversubscribed. given it's a fairly low threshold of 40 billion they're looking for. And the bonds are very attractive. They're tax-free to add to that.
Mm-hmm.
Yeah, so expect action to be skewed towards the bond market with the results coming in next week.
Okay,
Yeah.
Interesting. And right now,
Mm-hmm.
with everything not only going on locally but internationally, what are the main maybe news topics or announcements you're looking out for the rest of the week that would help guide, an investment decision?
Great. For one, I'm really looking forward to tomorrow's central bank rate decision. I'm also keen on the US Fed, especially the decision they'll make on rates.
Yeah.
I anticipate they will make a impromptu meeting, maybe towards the end of this month.
Okay. But it'd probably only be like 25 basis points, right?
Yeah, but even if it's 25 basis points, it's a signal to the markets that now rates are headed lower. So even the portfolio rebalancing will be skewed now away from cash and near cash assets, back into equities. You'll start seeing a divestment of flows away from fixed income assets back into the equities market, not only in developed markets, but even in emerging and frontiers, such as where we sit. So that would be a momentous decision. In as much as, yes, the BOE, ECB have done it, I think the turn in the needle would be now the US Fed making the decision to lower the rates.
Okay.
Yeah,
and as you had mentioned earlier, I think it's also important to note that people really don't understand how impactful the Federal Reserve is globally.
Yeah.
Like, you may think, it's Washington, D.C., no one cares and stuff, but being that the U.S. dollar is still the world reserve currency for now, that decision has a huge impact on global markets. And many countries, many corporates, they all base everything they do off that U.S. dollar. So, I just wanted to mention that because I think, even some of our viewers may not understand just how impactful the Federal Reserve is to every corner of the world. But that also means if the U.S. market crashes, you may feel it at home too.
Absolutely. I couldn't agree more.
Yeah.
Certainly the decisions by key central banks such as the US Fed, Bank of England, the European Central Bank have material implications for capital markets. And the response time is almost instantaneous.
Yeah.
From the time the Fed makes the decision, you almost see flows tilting instantaneously. Even currency differentials start adjusting almost in tune with that decision. Yeah.
Okay, interesting. Now, my last question for you. I already asked you what you're watching this week. You said the Fed and CBK decisions.
Yes.
What is your outlook going on right now for your clients? You said director of research. So how are you advising clients? How are you advising your people, maybe even your employees, on what is taking place currently and how they should make moves to, I guess, either protect themselves from it or compensate for it?
All right. At the start of the year, we launched our 2024 investment play. And one of the key themes we highlighted in the report that we've anticipated will shape the year was that we perceive that we are entering a new regime of higher market volatility across and within asset classes. And true to it, we've seen over the past 2 quarters increased volatility and dispersion of returns in the equity space, and also a lot of disturbance on the fixed income side.
Okay.
Yeah. And what that means in such a volatile kind of market, even investment strategies have to adjust. That is to say, now the typical buy and hold strategy in a regime where there's a lot of volatility, where the Kenya stock market moved from the worst stock market to the best stock market in dollar returns.
That's a lot of volatility.
In 1 quarter.
Yeah.
That's a lot of volatility. So our recommendations to our clients was that, one, investors need to adjust their portfolios, tilting exposure towards breakaway growth sectors while reducing exposures to underperforming sectors.
So sector diversification.
Yes, but selective diversification.
Okay.
Yeah, in as much as yes, we want exposures to all sectors, there's increasingly low tolerance to underperforming sectors.
Yeah.
That means we have to shake off or reduce at least.
Take like media, for example. The media industry, the blue chip medias, NMG, Standard, haven't been doing too hot in the market.
They've been loss-making over the past fiscal year.
Yeah.
And if you look at manufacturing counters, they've really been countering headwinds from the high inflation, elevated interest rates, low consumer demand.
Even had Mobius announced voluntary liquidation today.
Needless to say.
Yeah.
And to add to that, we know now there are other sectors that were really performing very well. The banking sector really, to start with, recording unprecedented profitability levels over last year and even spilling over into this year. So even our investment recommendations, you'll find they have a bias towards the banking sector and a little bit also towards the telco sector, which we think Safaricom in particular has been quite undervalued, and it's actually a good moment to back up on the stock.
Yeah.
Given that we are at a turning point of the business cycle, with rates coming down and flows coming back to equities.
Okay.
Yeah.
Interesting. Well, I think that's really good advice for people to take. So you said selective diversification.
Yes.
All right. Well, thank you so much for joining us. Thank you for helping us understand what is going on in the global markets right now, but we appreciate it.
Much obliged.
All right.
Thank you.